Welcome to Lesson 37, T3 Lesson 4. Today we cover leverage and margin, the most important concepts in futures trading. What you'll learn: what leverage actually is, how to read margin and liquidation price, why higher multiples are so dangerous. Get these right, and you can protect your capital. The same discipline that matters on a Fed day when the S&P 500 swings hard. As we go, compare what you see here with your own trading screen. In futures trading, leverage means using borrowed money to trade a larger size, a lot like a bank loan. Simple example: you have $1,000 and you use 10x leverage. You're controlling $10,000 of Bitcoin. A 5% to gain makes you $500. A 5% of loss costs you $500. Profits can scale 10x, and losses scale exactly 10x too. That's why people call it a double-edged sword. One wrong move and margin can vanish in seconds. So the higher the multiple, the more carefully you have to watch. Margin is the money you post with the exchange to open a trade, like a security deposit when you rent an apartment. Losses during the trade come out of that margin. Required margin ratios differ by exchange and by product, so always check before you trade. Even for the same Bitcoin contract, it can change by venue and by how volatile the market is. Fed week on the Nasdaq feels different from a quiet summer Friday. Higher leverage means less margin required. $1,000 at 50x can control a huge notional, and the risk scales with it. At 50x, a 2% price drop can wipe out 100% of your margin. So a move smaller than a coffee going from $3 to $4.50 can force liquidate you. The liquidation price is the level where your margin is fully gone. The exchange automatically force closes your position there. On most screens, it's labeled LIQ, or liquidation price. Higher leverage pulls that liquidation price much closer to the current price. At 10x, there's meaningful room. At 50x, you're often under 2% away from the mark. Lower leverage pushes liquidation farther away, so you have more room to survive a temporary move against you, the way a diversified S&P 500 holder survives a rough week. Once you're liquidated, that position is closed for good. The loss is locked in. You can't undo it. Compare it yourself. You have $1,000 and Bitcoin drops 2% too. In spot, that's a $20 loss. At 50x leverage, the whole stake is gone. Losses aren't just magnified 50x. When margin runs out, the exchange liquidates you automatically, whether you want it or not. There's almost no time in that process. Watching dollars melt on screen is terrifying, and after liquidation, there's no rewind. Historically, high leverage is the biggest trap new traders fall into. Just recognizing that puts you halfway ahead of the crowd. First, start with spot. Get comfortable without borrowed money before futures is safe. Chart reading and living through real losses need time to sink in. Second, if you do trade futures, start at extremely low leverage, around 2x to 3x. Feel how scary multiples are in live markets. Third, never go all in on one shot. Split your capital into 10 parts and trade small size repeatedly while you learn the rules, like budgeting groceries before you splurge. Fourth, before every trade, check the liquidation price and ask, is the loss from here to liquidation an amount I can actually afford? Quick recap. Leverage scales both profits and losses by the multiple. Run out of margin and you get auto-liquidated. Liquidation price is your safety line. Ignore it and capital can vanish in seconds. High leverage is a tool for experienced traders. Beginners who crank the multiple face losses that accelerate too fast without enough experience large drawdowns become likely. Next, Lesson 38. T3 Lesson 5 covers trading psychology, how emotions wreck trades, and what to do about it. This lesson is for education only, not investment advice. You own every trade decision. Study first, and only use leverage you can truly afford. If this helped, hit like and subscribe.